Hello everyone. Welcome to today's class on the structure of Indian banking and the types of banks. By the end of this session, you'll clearly understand why we need banking services, what a bank really means and how it functions, the different types of banks and credit institutions that operate in India, the key functions they perform, how the banking sector is regulated and supervised, and finally, the recent trends that are shaping the future of Indian banking. Sounds interesting, right? So, let's get started. Before we begin, pause for a second and think, have you ever wondered why banks are such an important part of our lives? That's exactly what we are going to explore today. The Indian banking system has come a long way. It has transformed dramatically over the last 2 centuries. Before 1955, most commercial banks were privately owned, often controlled by big business houses or royal families. Their reach was limited, and most of their services were focused only on cities. Can you imagine that? Banks that served just a handful of people, while most of India had no access at all. Then came a major turning point in 1955, the creation of the State Bank of India. It was formed by converting the Imperial Bank of India into a government-owned institution. This move changed the face of Indian banking. And soon after, the government went a step further, nationalizing major commercial banks, first in 1969 and later in 1980. Let's pause here for a second. Why do you think the government took such a big step? Yes, to expand banking beyond cities, to villages, farmers, and small businesses. These reforms widened the banking network and made credit accessible to rural and underserved areas. Now, fast forward to 1991, another big shift. The financial sector reforms began. New private banks entered the market, competition increased, and technology started changing the way banks worked. This was the beginning of modern banking in India, customer-focused, digital, and full of innovative financial products. Today, Indian banks offer almost everything from savings and remittance to credit, insurance, and investment. Our banking system now includes commercial banks, cooperative banks, regional rural banks, small finance banks, payment banks, and even non-banking financial institutions. Together, these institutions form a strong network that not only supports India's economic growth but also ensures financial inclusion across the country. Now that we've understood the historical background, let's move ahead and explore why do we actually need banking services. In today's world, banking services aren't a luxury anymore, they've become a basic necessity for everyone. Think about it, whether you're a student saving your pocket money, a farmer buying seeds, or a shopkeeper managing daily sales, everyone needs some kind of banking support. People from all walks of life depend on services like savings, insurance, and most importantly, credit. Banks make it possible for us to save securely, borrow money for productive purposes, and make payments easily and conveniently. But here's something to think about. Did everyone in India always have this access? Not really. For a long time, a large part of our population, especially those in rural and semi-urban areas, was left out of formal banking. Their financial needs were small but very important, things like saving for emergencies or borrowing a small amount for seeds, tools, or education. And they needed someone to guide them, to help them understand how to use these services effectively. To bridge this gap, the business correspondent and business facilitator model was introduced. Under this model, banks appoint local agents or institutions to act as their extended arms in unbanked areas. These agents, called business correspondent agents, or BCAs, play a crucial role. They help people open accounts, make deposits, withdraw cash, and access a variety of financial services right at their doorstep. Now, isn't that a powerful step toward financial inclusion? This system has played a major role in promoting financial inclusion, making sure that every citizen, no matter where they live, has access to formal banking services. Just imagine, someone in a remote village can now open a bank account, save money safely, or even receive government benefits directly into their account. That's the power of inclusion. So, the need for banking services really comes from one important goal: inclusive development. It's about giving everyone the opportunity to save, borrow, insure, and transact safely through formal channels. Pause and think for a moment: when people have access to such services, doesn't it make them more confident, more empowered to plan their future? That's exactly what inclusive banking aims to achieve. Now, let's move on and understand what exactly is a bank. A bank is a financial institution that acts as a bridge between two groups: those who have extra money, like savers or investors, and those who need money, like borrowers. In simple words, banks collect money from the public in the form of deposits and then use that money to give out loans and advances to individuals and businesses. Let's take an example. When you deposit your savings in a bank, that money doesn't just sit there. The bank lends it to someone who needs a loan for a shop, a farm, or maybe a new house. So, in a way, your savings help others grow, and that's how the whole economy moves forward. Banks perform a wide range of services. Some of the major ones include accepting deposits in savings, current, and term accounts, providing remittance facilities like demand drafts and online transfers, making bill payments and collecting taxes on behalf of the government, granting loans for trade, business, agriculture, housing, and personal needs, facilitating foreign exchange transactions, offering safe deposit vaults, operating ATMs and issuing debit or credit cards, and even selling insurance and mutual fund products. Now, if we categorize these activities, the primary functions of a bank are deposit-taking, lending, and investment. The secondary functions include services like remittance, safe custody, and other financial facilities. So, banks play a vital role in our economic system by mobilizing savings and channeling them into productive investments. You can think of banks as the heart of the economy, pumping money where it's needed most to keep everything running smoothly. Now that we understand what banks actually do, let's move on and explore the structure of the Indian banking system. Now that we know what banks do, let's understand how the Indian banking system is structured. Broadly speaking, the Indian banking system is divided into two categories: scheduled banks and non-scheduled banks. Here's an easy way to remember it. If a bank's name is included in the second schedule of the Reserve Bank of India Act, 1934, it is called a scheduled bank. All other banks, which are not listed there, are known as non-scheduled banks. Can you guess why being a scheduled bank matters? Well, scheduled banks enjoy certain privileges that non-scheduled banks don't. For example, they have access to loans from the Reserve Bank of India, eligibility for refinancing facilities, membership of clearing houses, and permission to hold currency chests for safe storage of cash. So, being on that schedule isn't just about prestige, it directly affects how a bank operates and how much support it gets from the RBI. Now that we've understood this classification, let's move ahead and discuss the different types of banks that form part of this structure. Let's start with public sector banks. These are banks in which the Government of India holds the majority stake. In simple terms, the government owns more than half of these banks and plays a major role in their management. The public sector banking system began with the establishment of the State Bank of India, or SBI, in 1955, followed by its subsidiary banks in 1959. Later, 20 major banks were nationalized into phases, first in 1969 and then in 1980. Can you guess why the government did this? Exactly, to strengthen the banking system and make sure that banking services reached everyone, not just big cities or businesses. In recent years, to create stronger and more efficient institutions, the government has merged several public sector banks. As of now, there are 12 public sector banks in India. Among these, the State Bank of India is the largest. It serves over 48 crore customers through more than 22,000 branches. SBI also has subsidiaries like SBI Life Insurance, SBI Mutual Fund, and SBI Cards, offering a wide range of financial services. So, public sector banks are not just financial institutions, they are a backbone of India's banking system, connecting millions of people to essential financial services. Private sector banks are those whose ownership lies primarily with private individuals and institutions. They are categorized into old generation and new generation private banks. Old generation banks are smaller, regionally focused, and follow traditional management practices. New generation banks, established after 1993, are technology-driven, competitive, and customer-oriented. They provide services comparable to global standards and are known for innovation and efficiency. There are 21 private sector banks functioning in India as of May 2023. Next, let's talk about foreign banks. These banks are incorporated abroad but operate in India through branches that are licensed by the Reserve Bank of India. Now, here's an interesting point: their operations are mainly concentrated in metropolitan cities and state capitals. Can you guess why? Exactly, because they mostly deal with large businesses, trade finance, and foreign exchange services, which are more common in urban centers. Foreign banks specialize in areas such as corporate banking, foreign exchange, and trade finance. So, if you are a big business dealing with imports or exports, these banks often provide specialized services that public or private sector banks may not offer. As of May 2023, there are about 45 foreign banks operating in India. Even though they are fewer in number, they play an important role in connecting India's economy to global markets. Regional rural banks were established under the RRB Act of 1976 with the primary goal of promoting rural development. They are jointly owned by the central government, 50%, the state government, 15%, and the sponsoring public sector bank, 35%. RRBs focus on extending credit to small farmers, artisans, and rural entrepreneurs. Over the years, several RRBs have been merged to enhance their viability. Currently, there are 43 regional rural banks operating across India. Next, let's look at local area banks. These banks were introduced in 1996 with a very specific goal to mobilize rural savings and provide credit for local economic activities. They are registered as public limited companies under the Companies Act and must have a minimum capital of 5 crore. Now, here's something interesting: their area of operation is limited to just 3 contiguous districts. So, unlike national banks, these banks focus on very specific local regions to support smaller communities and local businesses. Currently, Only two local area banks remain functional in India, but they continue to play an important role in supporting local economies. Small finance banks, or SFBs, are scaled-down versions of commercial banks. Their primary objective is to provide banking services to small businesses, low-income households, farmers, and the unorganized sector. They are required to lend at least 75% of their total loans to the priority sector and ensure that at least 50% of their loans are below 25 lakhs rupees. As of May 2023, there are 12 small finance banks in India. Payments banks operates on a smaller scale without involving any credit risk. It can carry out most banking operations but can't advance loans or issue credit cards. They can accept demand deposits, savings and current accounts up to 2 lakh rupees per customer, but they cannot lend money or issue credit cards. They can, however, accept and send remittances, undertake utility bill payments, and distribute insurance and mutual fund products. Payments banks operate mainly through digital platforms, providing low-cost banking solutions to millions. Cooperative banks are registered under the State Cooperative Societies Act and operate on cooperative principles of mutual help. They are classified into urban cooperative banks and rural cooperative banks, which include state cooperative banks and district central cooperative banks. The Banking Regulation Act was amended in 2020 to expand the Reserve Bank's regulatory control over cooperative banks, ensuring better governance and financial stability. Cooperative banks primarily cater to small borrowers and local communities. Now that we have covered the structure and types of banks, let us move on to discuss the functions of banks. The functions of banks can be grouped into traditional and other functions. We will start with traditional functions. Acceptance of deposits. Banks mobilize savings from the public through various types of deposit accounts such as current accounts used mainly by businesses with no interest payable, savings accounts used by individuals offering nominal interest, term deposits including fixed, recurring, and cumulative deposits repayable after a fixed period. Term deposits form the largest portion of a bank's loanable funds. Loans and advances. Banks lend money in the form of loans, cash credits, overdrafts, and term loans. They charge interest on these loans, which constitutes their main source of income. Loans may be secured or unsecured, depending on whether collateral is provided. If loans are not repaid on time, they become non-performing assets, NPAs, which can affect the bank's profitability. Banks enable the transfer of funds between locations through instruments such as demand drafts, electronic transfers, and online banking. These services make payments quick, safe, and convenient for customers. Now that we have talked about the traditional services of banks, now let's learn about some of the miscellaneous services that banks provide. Banks also provide services such as safe deposit lockers, issue of letters of credit and guarantees, collection of checks and bills, and agency services for government business. Modern banking has been revolutionized by technology. Electronic banking includes ATMs, debit and credit cards, internet banking, mobile banking, telebanking, and electronic payment systems like NEFT and RTGS. Electronic banking has made transactions faster, more efficient, and available anytime, anywhere. Now, let us examine how banks in India are regulated and supervised. The Reserve Bank of India, RBI, is the central authority responsible for regulating and supervising banks in India. Established in 1935, the RBI performs several critical roles. It acts as the note-issuing authority, serves as the banker's bank, acts as the banker to the government, and promotes monetary stability and economic growth. RBI ensures that banks operate safely, follow prudent practices, and protect depositors' interests. Institutions like NABARD, SIDBI, NHB, Exim Bank, and NABFID function under RBI's broad supervision and support priority sectors like agriculture, small industries, housing, international trade, and infrastructure. RBI also conducts regular inspections of banks to verify compliance with laws such as the Banking Regulation Act, 1949. Now, let us move to the final section of this lecture, Recent Trends in Indian Banking. RBI ensures that banks operate safely, follow prudent practices, and protect depositors' interests. Institutions like NABARD, SIDBI, NHB, Exim Bank, and NABFID function under RBI's broad supervision and support priority sectors like agriculture, small industries, housing, international trade, and infrastructure. RBI also conducts regular inspections of banks to verify compliance with laws such as the Banking Regulation Act, 1949. Now, let us move to the final section of this lecture, Recent Trends in Indian Banking. The Indian banking sector has been evolving rapidly, adapting to new technologies and customer needs. Let us discuss some key trends. Greater operational freedom. RBI has deregulated interest rates, allowing banks to determine rates on deposits and loans within broad guidelines. This has given banks more flexibility while promoting transparency. Consolidation of banks. Mergers and acquisitions have created stronger banks with larger capital bases and greater efficiency. Consolidation helps in achieving economies of scale and enhances global competitiveness. Emergence of universal banking. Universal banking refers to providing all financial services under one roof, including lending, investment, and advisory services. Banks now earn not only from interest income, but also from fee-based services such as insurance distribution and wealth management. Now, let's talk about some important government schemes that have helped bring millions of people into the formal financial system. Schemes like Pradhan Mantri Jan Dhan Yojana, Jeevan Jyoti Bima Yojana, and Suraksha Bima Yojana have made banking accessible to even the most remote citizens. But how did banks reach far-flung villages? That's where business correspondents come in. These agents act as the bank's extended hands, helping people open accounts, deposit money, and access various financial services even in the remotest rural areas. Thanks to these initiatives, formal banking is no longer limited to cities. Millions of rural families now have access to savings, insurance, and credit facilities. The adoption of core banking solutions, CBAs, mobile apps, internet banking, UPI, and digital wallets has completely transformed the way we interact with banks. Think about it today, you can transfer money, pay bills, or check your account anytime, anywhere. Transactions are faster, more secure, and available 24/7. This digital shift has not only made banking convenient, but has also improved the overall customer experience, making it easier for everyone to manage their finances efficiently. Mobile phones have penetrated deep into rural India. Today, even in remote villages, mobile connectivity is common, and usage by the common man has become a part of daily life. It is estimated that nearly 1/4 of all mobile users in the country reside in villages and small towns. This widespread reach presents an enormous opportunity for extending formal financial services to previously excluded populations. By leveraging the accessibility of mobile networks, banks can now deliver essential services to people who were once beyond the reach of traditional banking infrastructure. Subscribers can perform a variety of financial transactions, such as transferring funds or making deposits and withdrawals independent of place and time. In fact, a customer can approach a local mobile network retailer for cash withdrawal or deposit, and the transaction is processed securely using SMS messages or digital authentication methods. Today, mobile banking offers a wide range of convenient services. You can transfer funds, make immediate payments, check your balance, and even view mini statements all from your phone. It also allows dematerialized account services, checkbook requests, and bill payments, among other things. And here's the best part, all these transactions are done securely through a mobile-based PIN system, ensuring your money and personal information remain safe. So, with just a few taps on your phone, you can manage almost all your banking needs anytime, anywhere. Let us now summarize what we have learned. India's banking system consists of various types of institutions, including public sector banks, private sector banks, foreign banks, regional rural banks, cooperative banks, small finance banks, and payment banks. The Reserve Bank of India acts as the central regulator and ensures stability in the system. Development financial institutions such as NABARD and SIDBI provide refinance and support specific sectors. Banks perform multiple functions, accepting deposits, lending money, enabling remittances, and offering a wide range of modern financial services. Recent trends show greater operational freedom, technological advancement, consolidation, and an increased focus on financial inclusion. The Indian banking sector continues to evolve, becoming more efficient, inclusive, and technologically advanced, contributing significantly to the country's economic development. Thank you. Let us now review some key terms and concepts related to this chapter. Scheduled banks, banks which have been included in the second schedule to the Reserve Bank of India Act, 1934. Public sector banks, major government-owned banks where the Government of India holds more than 50% of the stake. Their shares are listed on the stock exchange. Private sector banks, banks where private ownership is more than 51%. New generation banks, banks with advanced technology that support inclusive economic growth. Regional rural banks established under the RRB Act, 1976 to serve rural areas. Jointly owned by the Government of India, state governments, and sponsoring public sector banks. Differentiated banks, also known as niche banks, serve specific segments such as small finance banks and payments banks. Local area banks, registered as public limited companies to meet the credit needs of local people within 3 contiguous districts. Payments banks operate on a smaller scale without credit risk. They accept deposits up to 2 lakh rupees, offer remittance and payment services, and provide debit cards but cannot lend money. Urban cooperative banks operate in urban and semi-urban areas to serve small borrowers and local businesses. Rural cooperative banks provide agricultural credit through a 3-tier structure: tax, DCCBs, and STCBs. Reserve Bank of India Act, 1934 established the RBI to regulate currency, control credit, and ensure monetary stability in India. Banking Regulation Act, 1949 provides the framework for banking operations, licensing, management, inspection, and mergers. Demand deposits, deposits withdrawable anytime without notice, such as savings or current accounts. Term deposits, deposits locked for a fixed period, withdrawn only after notice or maturity. Electronic banking, banking through electronic signals instead of physical cash. Mobile banking, performing financial transactions through a mobile device such as a phone or tablet. Safe deposit lockers established the RBI to regulate currency, control credit, and ensure monetary stability in India. Real-time gross settlement (RTGS), a system allowing instantaneous fund transfers settled individually and in real time. National Electronic Funds Transfer (NEFT), a system that enables fund transfers between any to NEFT-enabled bank accounts in batches.